So it seems like the stock market went on a Thanksgiving holiday a day early. I mean, it's very quiet, very boring today. But there were some interesting moves in other markets, and there are some interesting technical patterns setting up in the broad market, the S&P, that I'm going to talk about and break down in today's video. So even though the market didn't do anything, there are some things to talk about. Now, one quick note before we get started. Friday usually is if today is bad, Friday usually is worse, especially because it's only a half day of trading. So with that being said, I'm not going to come on Friday unless something significant happens to break us out one way or the other. I'll see you. The next video will be on Monday. So if you don't make it to the end, happy Thanksgiving. Have a great weekend. Let's go ahead and get started. Today is Wednesday, November the 22nd, 2017. My name is David Settle. This is my market outlook for today. Welcome to those that are watching for the first time. Thank you very much for watching. Welcome back to those who used to watch me somewhere else. Found me here. To be able to keep watching me day after day, hit that subscribe button right below the video. It's a red button you'll see there. Hit the thumbs up. Let me know that you found today's video useful. It's a really one-click way to give me some feedback. Scroll down to the bottom of the page, comment on anything that stood out to you from today's video. I'd love to see your comments there. You'll see a few links in that description box. One of them is to my email newsletter I send out every day for the Market Outlook. If you want to get that email, which has a lot of great resources in it, subscribe to that list by clicking on that link. Follow me on Twitter for more content in addition to these videos. You'll see my handle on the screen, DavidSettle42. Pinned to the top of my timeline. When you go to that page, you'll see today's Market Outlook tweet. Like and retweet that to let other people know that they should be checking out too. The more you do that, the more Twitter promotes that particular tweet to everybody out there that would be interested in this type of content. All right, we'll start off by taking a look at the S&P 500 with the market forecast indicator, and you can see the posture's turned back to being bullish, and yesterday was turned back to being bullish. Now back up above 80. Again, remember, I mean, look at it like this, zoomed out, and you can see, and we're already to higher highs. We've already gotten a series of lower highs in the intermediate line with higher highs on the index. So there's that possibility still of a divergence setting up on the intermediate line, which is more significant than divergences on the blue line, on the near-term line. So we're going to keep our eyes tuned for that. But as of now, the posture is strongly bullish. We mentioned that there is, there was the possibility that we get up to slightly higher high. We did that yesterday. We got a higher low today, but the range is just, it's holiday. It's holiday trading. That's pretty much what it is. The near-term line got up into the reversal zone, so that's great for a bullish posture. We've got how many days now above 50? 1, 2, 3, 4, 5. 5 days above 50 here. So good bullish move for the index that we've already had. So it's like, okay, well, if the average is 7 to 10 or 7 to 12, and usually it's longer when you're at the beginnings of an intermediate run and shorter as you get towards the end of an intermediate run, then, again, how much longer is a near-term run going to last? Again, we don't have to break, if we're not strongly bullish, we don't have to be strongly bearish. It just means that, man, I've got to manage my expectations of how bullish I am right now. And I mentioned this before. I've been teaching people how to trade, how to trend trade, especially for years, for almost 14 years, over 10 years in the coaching capacity. And a lot of time, and the strategy is the same, no matter when the market, that particular student started their journey, their individual journey. And if they happen to start like right now, trading the same rules as somebody who started 2 months earlier, simply because that's when they started, then the system looks a lot better over here than it does right here. And simply because the expectations are the same for success rate here on any kind of trend trading strategy as it would be over here when the market sentiment's down, the intermediate's down and rising. And so that's the difference, right? So as things change, then our expectations for new positions have to change along with them. And that's kind of what we're at right now. We just have lower expectations in terms of how bullish we are. There's the first near-term run on the intermediate, on the bullish. Well, actually, this is the first near-term run that got the intermediate line above 50. That push right there. Then we kind of consolidated into a little pennant formation. We broke out. There's the next near-term run. consolidated next near-term run, which is a lot bigger than normal, simply because that didn't pull back enough right there. This is where the consolidation was and didn't pull back enough. So we had 1, 2 near-term runs put together essentially. Here's your pullback, here's the next near-term run, here's the pullback, a little bit bigger. So you see how the pullbacks now are getting, here it was kind of really sideways, a pennant. Very, very small pullback. Short, but a little deeper pullback. Now we're getting deeper and longer pullbacks. So you see how things are changing. So we should have changed. We should adapt how what we're looking at and how we're looking at things. And mainly because, again, market sentiment's high and intermediate posture has been bullish. Now, again, discount this weak bearish posture. We didn't go from bullish to bearish here. We don't really get to bearish until we get this kind of move where we drop below 50. Even that was enough to produce, and you see I've got the orange ovals here for the intermediate low points. So this is not, I notice I didn't put an orange oval here. This is not an intermediate low point. It was just simply a weak bearish posture because it was a near-term pullback that was bigger and longer than what we've seen. And it was enough to create a weak bearish posture, which typically happens before you get more of a stronger bearish posture eventually. Maybe not Friday in a half day of trading, maybe not even Monday, maybe starting Monday, but maybe not even Monday. But eventually, we're seeing the pullbacks are getting deeper and longer here. You can see the Dow Jones Industrial Average looks very similar. A little bit of a pullback today on the Dow Jones, a little bit more of a pullback, but the intermediate posture is still strongly bullish because it's back up above 80. The near-term line here is not above 80, so kind of keep an eye out for that. Not as bullish. Again, we did get to an all-time high yesterday. Closing high, but not as bullish. You take a look at the NASDAQ composite. Like the Russell 2000, really killing it. The posture is still strongly bullish, has been. Again, for going on 3 months now. There's your near-term runs here. Your first near-term run. Here's your next near-term run. Here's the next one right here. And every one of them brings the near-term line lower. And really, here was the next near-term run. You can see again, the size and scope of them. Always getting to you see the 6-week moving average in each one of these. And there's our, and we've had our near-term run up to new highs. And that's been mostly because the small cap, the NASDAQ composite includes the NASDAQ 100, which is what QQQ is, but also includes a bunch of small cap stocks, which is what we have with the Russell 2000. So big run in the Russell 2000, all, as we know, tax reform related, but the posture is now almost back to being strongly bullish there too. Strong near-term sentiment, and this short-term pullback in the momentum line because of how small today's trading range was across the board. The long-term view of this still looks obviously very similar to what we saw yesterday, just a small candle on the top there, but not, again, we start looking on these bullish charts. When we get above the moving average, we start looking for the long upper shadows, and obviously we're not getting that here. So no long upper shadow. We're not bearish yet. There's that long lower shadow, which is bearish, not as bearish, but which is bearish, and so you had some weakness coming off of that, and we traded within the range. But it's the longer upper shadows extended away from the moving average that leads to being more bearish, and we don't have that quite yet. If you look at the 3 green arrow chart, we did finally get that green arrow on the MACD, and again, like I said before, don't be surprised if we're a little bit above that for a while, like we were over here, before we continue to grind towards zero and these moving averages grind towards each other and we flatten out. And you can see the same divergences on the intermediate line from high to high to high are here too. So higher highs on this, lower highs in the corresponding indicator. So divergences kind of all over the place here with bigger pullbacks on the near term that we're seeing time after time after time. Alright, so now we look at the intraday. Look how small the move was, a half a point essentially, and easily inside yesterday's range. Now, it was a down day today, but if we had gone up to, like, say here yesterday and then closed up here, then you can see it'd be one day after another. And that's why I mentioned, like, we've pulled multiple days forward here in terms of how bullish we were. Just like here, we pulled multiple days forward. We had 2 weekdays. But when you look at it from here to, say, here to here and then to here, then you can see how it would have been a gradual move higher, that all those gains got pulled forward to there. And the same thing happened here. You'll see that when there's big ranges, we saw those big kind of extreme ranges. When you have big extreme ranges like that, that means things got pulled forward into a day. And of course for this, it was the Thanksgiving holiday. Not a lot of trading going on today, not a lot expected to go on, and only a half day on Friday, and so it got pulled forward. And so that's what we have going on right now. When you look at the volume, even lighter. So here, give it a second. And just kind of a note, if anything abnormal happens Friday, if we kind of break out here, up or down, then I'll do a video on Friday to talk about what happened and why. But if we just mired in this range, which most likely is the case, then there won't be a market outlook video on Friday. So don't plan on one unless there's some significant movement in the markets, and I'll do kind of a special one in that case. Otherwise, I'm going to be hanging out with the family Friday. Obviously a lot of change happening in the family here in the past couple of months, so we'll be taking some family time after the holiday, unless, like I said, something significant happens, and I'll come on and talk about it and why. Otherwise, I'll probably be out, beating the hordes down and looking for Christmas presents and hanging out with the kids and playing some hoops with my boys. But you look at the volume, 44 million, 45 million eventually. Put that in context, way below the average. The range way down here. So very, very, it's holidays, so don't put a lot of stock into it more than that. And again, we had extreme range yesterday, a little bit above average volume, and that's why, that yesterday got pulled into today. And then finally, from a volatility standpoint, volatility stays low, stayed below 10, but on a relative basis, it rallied. You see how it grew, still extremely low. So that's why, again, probably going to be a grind Friday, probably not a whole lot of movement. And then Monday will be the day that we'll come back and see if volatility starts to bounce back up from this extreme low again. In terms of what's driving the price action today, you'll see there's a lot on the calendar because, again, everything got pulled forward, right, for the holiday. You have durable goods orders here that came in a little bit below expectations. You have consumer sentiment, which was a revision that looked really good. And then you have the FOMC minutes, where it was pretty much as expected. They didn't raise rates, and they're going to raise rates in December. And there's some debate between the hawks and the doves, but the issue is, are interest rates too low for too long? We've seen in the past that's been a detriment for the economy because it leads to excesses. Have we seen excesses yet? Because we all know the adage that markets do not die of old age. Bull markets die of excesses. We haven't really seen the excesses like we've seen during the tech bubble. We haven't seen the excesses like we saw during the housing market. We haven't really seen those level of excesses. What I find a little interesting, and probably people smarter than me know more about this than I do, but what I find interesting is seeing the line of RVs living in San Francisco area because they can't afford the actual housing. They'd rather live in the RV. Or the idea that healthcare premiums, especially for individuals, are rising. Something I've been a lot more attuned to here more recently. But healthcare premiums are getting to the point where it's hard to pay both, higher premiums and the higher deductibles that come along with that, especially for the individual plans. And so the idea being that we might not have excesses in terms of people just taking risks like crazy, like we've seen in the past. I mean, there's some risk taking, but not to the same excessive extent. But there's also been some things that are kind of dampening consumer ability. Now, you haven't seen that impact on the consumer sentiment yet, but when will that be the case? Where for example, a small business owner says, I can't purchase this or that. And especially like when you look at inflation, they're looking at more discretionary or non-discretionary items. But when you're looking at more discretionary items, which is where a lot of these stocks we look at, Netflix is kind of a discretionary item. A lot of these kind of companies, now they would want to make themselves as non-discretionary as possible, but the idea being a lot of these stocks have discretionary products. When will housing and healthcare and a lot of these non-discretionary costs be too burdensome for the consumer? And the consumer sentiment right now And a lot of it's so bullish because of stock markets hitting all-time highs, very, very low volatility will make consumer sentiment high because they're seeing their stock markets doing really well. And then you also have gas prices not excessively high. We've seen excessive high prices in the gasoline oil market too, right? And that bubble burst. So we just haven't really seen that excess yet in the market, and so you have strong sentiment, but it is there. I mean, look how strong economic indicators are, and most of that are these sentiment surveys. Now, other than that, really nothing happened today. Fed rate hike expectations are the same, and GDP expectations are the same. But that's the debate in the Fed: is do we need to raise rates? Because if we keep them too low for too long, that will lead to excesses. Or if we keep them too low for too long, will we become Japan, where economic growth just stagnated, and for that matter, probably still stagnated. It still is flatter than it has been, obviously, when it was during its heyday back in the 80s. So that's the question, that the debate. But they're pretty unanimous in the fact that no rate hikes last meeting, and the futures market is pretty unanimous in the fact that there's going to be one rate hike in December at their next meeting in December. You can see pretty close, a little pullback, but you're still talking over 90% odds. You see here on the 2-week basis just how strong small caps and emerging markets, so very risk on. If I were just to zoom in on this week, again, those are those are the 3 riskiest asset classes out of all of these: small cap stocks, emerging markets, international stocks, and the crude oil. They've had the biggest gains. So there's been some risk appetite, and a lot of that's coming from the outperformance in international stocks over U.S. stocks. That they are the ones that caused the pullback, and they are the ones right now that are leading the way higher. You can see the dollar down, gold down, treasuries and high yield down, though you see that high yield is now lower on the week because of today than treasuries. You can see today treasuries had a good day. Again, small moves. You had the dollar really down today, but you notice that move down in the dollar didn't impact rate hike expectations, but didn't impact GDP expectations or what the economic indicators are doing. So you almost see like the dollar is like saying, don't put a lot of stock into this, all right? Because again, currency values derive their demand from a trading perspective on a relative strength basis. Is our economy relatively stronger than the alternative? And does that stronger economy or stronger economic expectations lead to higher yields? Because again, yields typically go up with strengthening economies, and as long-term yields especially, but short-term yields start to go up as central banks starting to tighten their policies. That leads to higher yields, so that draws in currency demand as people want to get those, and investors want to get those higher yields. You have to exchange into those currencies to get those higher yields. So, right now, U.S. has the higher yields, and you can see the economic indicators are supposed to be signaling potential, decent growth from an economic perspective, but the currency is saying, like Lee Corso from college football, not so fast, my friend. You see that here's the chart of the U.S. dollar. This is not a chart of a currency that has higher rate expectations compared to its peers. As the U.S. dollar is actually breaking through the lower Bollinger. It's already broken through the moving average, which is trend changing, and now it's broken through the lower Bollinger Band. So now you expect a bearish trend as we've seen for pretty much. Since the election. If I were to zoom back out from the election, the dollar actually took off immediately right after the election. You can see, boom, dollar had a good run. The idea being that, again, a lot of the administration's policies would be very pro-dollar. Not so much, right? Not so much there. As you can see now, the dollar's really kind of taken off. It had a little bit of a bounce here recently, dropping again. Now, remember, stocks are denominated in dollars. So as dollar falls, the value of stocks rise. Now, there's obviously a lot more to the value of a stock just from the currency that it's denominated in, right? Because there's earnings and there's everything that stimulates buyer demand. But take all that other stuff out, and just from a currency perspective, they're denominated in dollars. So the dollar falls, the value of those stocks rise, absent anything else that impacts those values. Here's those those inflation expectations. The 5-year forward inflation expectation rate. You can see as soon as the election came about here, there's the election, right? And then from the election, the inflation expectations took off to 2.2%, and the dollar responded, and yields responded, and everything was fine. Then we dropped, right? Now we've had a little bit of a rally, and there was a rally in the dollar too that coincides with the latter end of that. But now, as you see, inflation expectations dropping, the dollar's dropping, and again, the 10-year note has been declining too. You see, there's the election. 10-year note rallies. As the dollar and inflation falls, so does the 10-year note. A little bit of a bounce here recently. Now, not so much. Right now, we're starting to pull back. And you remember on the daily chart, there's that inverse head and shoulders pattern developing. This is not the pattern from a currency and bond market perspective of markets that expect relative strength in the U.S. economy relative to its peers. Which again, we talked about, having international stocks. And we saw this week international stocks outperforming U.S. stocks. If your whole portfolio is U.S. based, even if it goes up like it has this year, it hasn't gone up as much as those international stocks have this year. And according to what we're seeing in these markets, that could still continue to be the case. All right, so from a sector rotation, you can see discretionary and consumer stocks have been doing really, really well the last 2 weeks. There's discretionary and staples. Both have been doing well. Technology outpacing and energy lagging. And again, that energy sector performance yesterday lagged behind oils. Today, oil continued up, and so did energy stocks finally bouncing up. Discretionary, you can see industrials doing well too. Man, that falling yields and the falling yield spread just has not been helping the financial sector. This is the relative strength of the financial sector compared to the broad market, and man, we really rallied once the election came, and then we rallied here recently with the rise in the dollar and all that. But with the dollar dropping and the yields dropping and inflation expectations dropping, the yield spread's been dropping. Look at what's doing to and there's your yield. If we were to take a look at the yield spread here, where is it? Right, this is the yield curve. Here it is, yield spread, 30-year to 5-year. Look at that. This has not helped the financial sector, right? The financial sector likes a rise here, and you can see the rise, but not this. And look how, we have to go back. We have to go way back. To back here in 2000. Now, again, you can see a falling yield spread. The market peaked in 2007, right there. Now, the increase in volatility started February 2007. And you can see that was a year. So the increase in volatility started a year after the yield spread hit an inverted yield curve. And then finally, the market peaked almost 2 years after the inverted yield curve. So a falling yield spread is not a bearish indicator. In fact, it's actually a bullish indicator. But in this particular case, where we were falling in 04, 05, you can see that there. Here's where things are a little different, because as we were falling from 04 to 06, this yield spread kind of really taken off to the downside. Here's where the 10-year yield note, this is on the side, this is the 10-year note. You can see it rallied that whole time. Boom, took off in the middle of 04, probably about what, 3.3%. What was that? Under 3%, or under 4%, and then all the way up here to about 5.25%. So big move. And here you can see, we're taking off, but yields are starting to roll over. So a little bit of a different story from a 10-year note perspective coinciding with this yield spread. So we'd like to see, if this is going to continue down, which is not a bad thing, this has got to go up. And the inflation expectations have to go up. See, here's your inflation expectations during that time here, where that yield spread was falling and the 10-year note was rising. See, inflation expectations were rising. And this needs to rise again. Otherwise, a falling dollar and flying inflation expectations, falling yields is going to make other asset classes, especially internationally, look a lot. So with today's move, our trade idea of the day, there's some weakness in the technology sector. Consumer stocks have been looking really good, but there's some weakness in the technology sector, even though it's been very, very strong lately. And you can see one of those stocks here, kind of a technology, semi-technology, kind of consumer related stock, Salesforce.com. Has been very bullish to the fact that its MACD is very high. Now, you know, MACDs don't always drop sharply. They tend to grind from these higher levels. And so, you know, if they do drop sharply, we'll kind of look for some opportunity here for a way to profit from a pullback. Here's one way you can do that. Because you notice here, its volatility is relatively low. So that means there's not a whole lot of premium. And the spreads are a little wide, so we need to keep an eye on that. But if I were to jump up here to this December contract, and we say, okay, what if I were to sell this put? 103 put. And again, you have to see how much you'll get because it's a little bit wider spread. So play around with that spread a little bit. But instead of protecting that by buying a put, you know, that's out here, and you know, which is bullish, right? We're trying to profit from the pullback, not from the bullishness. Instead of doing that, what I'm going to do instead is come out here to January, and I'm going to buy a 105 put out here. So it's going to be more expensive than what I'm getting. Now I'm getting a debit, and again, you have to play around with this debit to see what you get because of those spreads. But now I'm going to throw that into the Analyze tab. There we go. And what I've got here is a situation from now until December the 16th. That's not very far away. I've got an opportunity to profit from a pullback. If we were to trade around 105, you can see my maximum gain is about $115. What if we kept going and brought all the way down to 100? Say, and this is one standard deviation, right? These lines. You can see one standard deviation, I'm going to lose about 26 bucks. This, and looking at, or excuse me, 42. Look at the kind of teal line here, the blue line, 42 bucks. And again, a gain of 115-ish. So that's a pretty decent profit loss ratio, almost 3 to 1. On the other end, if we were to continue just to take off like a rocket ship, then I'll lose about 97 bucks. So less than what I'm making, than what my potential reward is. You know, and again, you can see where the max loss and max gains are. And we also see, you know, when you look at CRM from like a linear regression standpoint, we're very strongly bullish here. So, you know, the upside is going to be more limited. Doesn't mean that we have to go down. It just means that there's going to be more pressure on the upside because of how bullish we already are to get to this point. So the likelihood of getting to 112 because of how bullish we've already been is less likely. It's 15% now, but in reality, it's probably a little bit less than that because of how far we've gone up to get to this point where we're at. So there's probably more potential reward to the downside, but you notice I've got, you know, my gains and my losses are a lot smaller to the downside than they would be one standard deviation to the upside. And then, you know, if we pull back and volatility starts to rise because we're past that earnings, right? We just had earnings. You can see if volatility starts to rise just a couple of points that I've adjusted down here, you still get to that same one standard deviation. Now we're looking at a $20 loss. And whereas before we were looking at about 101, you know, that now that gain, because these are positive beta trades, if we do pull back and volatility rises, that will help. And in fact, give me a little bit more of a maximum gain too, because there is no straight up maximum gain on this because of that long put that we own in a deeper time. It's not an out of the money put in the same time frame. It's the same strike price further out in time. So it gives me a positive vega and no, because remember, long puts don't have a maximum gain. The stock can go all the way to zero. That's really the upper limit to what a put can do, and that's why there's no maximum gain here either. So to summarize, and the stock market was quiet today, but there's more markets that were moving, especially the bond market in terms of yields and the currency and the dollar. So and the moves in the dollar and the yields are telling us some things about what are, and for that matter, the inflation expectation rate are telling us some things about what to expect from the economy, which right now, from sentiment surveys, are showing some really, really bullish indicators. From a GDP estimate standpoint, very, very bullish, but we're not seeing the markets tell us, other than stock market, which can be, as we know, irrationally exuberant, not telling us to, the other market's telling us not to necessarily trust that. So doesn't mean that we have to be bearish, right? We have to follow the trend. We're just going to follow the trend with, with caution. And with today's trade, I mean, it's a little bit of a bearish trade, but it's not too much. You got a short put there, which is bullish, but it allows us to profit from a pullback in the stock that's had a really good run, that if it were to kind of come back and grind, we've got a way to take advantage of that. So with that, thank you very much for watching tonight. I hope you all have a great weekend. Again, I won't be on Friday, barring anything dramatic happening. I won't be on Friday. We'll be back on Monday. I hope you all have a great Thanksgiving holiday tomorrow. In that spirit of kind of gratitude for the holiday, I really appreciate all of you who have come and watched these videos day in and day out. It means a lot. It's been significant, and the likes and the retweets and the comments have been very much appreciated, especially as we start getting something new rolling. We feel like we've got a lot of support, and so thank you very much for that, and we'll continue to build something that we hope you feel very, very proud of. So again, thanks. We'll see you all on Monday.